that I'm looking into that I'm super excited about buying. So just keep that in mind. But we're going to start off with our growth one, which, again, wild stuff here. Because if you look last year, there's no way I'm calling Disney a growth stock. You look a year ago, you just think of this as a value stock. It doesn't do much, really doesn't move much. In fact, if you look at the 5-year chart, I mean, look at this movement over this period through March of 2019. It didn't move at all in a 4-year period there. So the stock wasn't doing much, but then obviously you look year to date, and we've seen some weird, crazy stuff. Really only at 4% year to date, but doing pretty well really since that March of 2019 point, and a very good recovery from the dip earlier this year in March, right up around 79%. But why do I like this stock? Well, first you got to think about what Disney is. Obviously, we need to mention it. Right here on the homepage. First off, they feature Disney Plus. We're just looking at Disney's website. Disney Plus, massive, and we'll get into that in just a little bit. Other than that, obviously the Disney Shop, as you see up on your top here. We'll see how quickly this thing loads, but obviously your Disney Shop, big time around Christmas, no doubt. So, really cool stuff here. Disney Shop, boom. All these goodies for you. If you ever wanted some goodies, you got goodies because the Disney Shop's got you. Parks and Travel, really a segment that's been horrible for them this year, no doubt about it. But the immense restrictions are certainly out there. So you're talking about Disney World, Disneyland, and obviously worldwide. You have the same thing, but obviously this year they released Star Wars Galaxy's Edge to Disney World, I believe. But yeah, pretty new part of their park. Should be pretty exciting. Obviously, I've never been to either, but it's pretty cool. And obviously, they have their movie segment and media segment as well. So, what I really want to point out is many things for Disney. Talk about valuation, because I think it's important. And well, Disney right now, the valuation is a little janky. You can't lie, because the pandemic has quite devastated this company in terms of their profitability line. And it really has, and I get exactly why. Now, they've made up a lot of their business right now through streaming, which, if you've looked at any other company through their history that's a streaming company, they've been unprofitable for quite a while. And some of these companies still are. So just keep that in mind, as you see a lot of their revenue now is coming from that, because their traditional high profit areas, frankly, they're just not making it right now. They're having issue in terms of movies, with movie theaters closed, parks and resorts closed. So they're having issues getting that profit. So they're having to make up the revenue elsewhere, and that's where you're seeing this EPS has been declining. But where I say that, again, you want to look here in terms of the financials, and well, this company's doing really, really, really decently this year. Trailing 12 months sitting around 750 or 75 billion dollars, and trading in a market cap of 279. Now, I don't think that's absurd by any means. We're talking about really only trading at a little bit under 4 times the multiple. There is not that bad for a stock of this kind. And for a stock of this kind, what do I mean by that? Well, what I mean by a stock of this kind is, let's be fair. This company right now is making or breaking the stock price based off of streaming. So I want to give a direct comparison to Netflix, which I think I need to do. And Netflix, if you look historically, even right now, this company, which is at much better valuations than it has been, is trading at a $220 billion market cap, yet only bringing in $23 billion in revenue. So that's trading at 10 times that value there, while Disney's trading at 4 times. Now, Netflix obviously has a much more established subscriber base, and you need to mention that too. But again, it's a similar type story, and Netflix is a one-sided pony. Yeah, they're a one-trick pony. Disney has so much more going for them, and that's really where I want to make that argument. But I want to argue in terms of what this company offers, and Disney Plus is going to be incredible. But I want to show you the impact that this year has and what this company can do. So I just want to preface this by saying parks and recreations and resorts for them have been shut down for a vast majority of this year. Yet they have seen revenue only decline 6% for the full year. And if you go down to their segmented revenue, you'll see the parks, experience, and products. They've seen a 37% decline this year. 37% of their revenue in terms of the parks and experiences, which was their largest segment, was 37% decline. I mean, you're talking about $10 billion in revenue they lost there. But where did they make it up? Well, why don't you just take a look at the direct-to-consumer internationals, which is, that's right, Disney Plus and streaming services. That saw a 81% increase so far this year at $16.9 billion compared to $9.3 billion. So a lot of that money they've made up, and they also made it up in media networks, baby. Acquisition of 21st Century Fox, and you know, various streaming in terms of ads, stuff like that. So really exciting to see. And studio entertainment's even down 13% too, because movie theaters haven't been open either. So you have to consider all of that when you're talking about this company, yet they've only seen a 6% total decline in revenues. That's incredible. I think that's really incredible. And that shows you, first off, vaccines. I mean, how many people are going to take them? I don't know. And who gets them first? When we finally get a full spread of vaccines, we've got estimates for summer of next year. Just think about that. Once vaccines are fully fledged and out there for this virus, we're going to see people return to these areas, parks and experiences for Disney. It's going to flourish yet again because people, after such a crappy year, they're going to want a vacation like no one's business, and they're going to want to go to places like Disney World, Disneyland, Disney resorts, Disney cruises. They're going to do everything that they couldn't do this year. People are going to be wanting to do that. So just keep that in mind. And on top of that, you're not shrinking your direct-to-consumer segment at all. Your Disney Plus segment is actually only growing. So when I talk about growth, and we'll scroll down here because I want to bring this up, why Disney Plus is so important. Disney Plus subscribers, as you see here, obviously year-over-year comparison isn't quite fair because they weren't doing it last year. 73 million people have subscribed to Disney Plus so far in a year's time. And less than a year's time. Incredible. So that is a number that in less than a year, 73 million. I think in total, most likely by first quarter of next year, they're going to be right around 100 million subscribers there. But you also have ESPN Plus to consider, which is growing subscribers quite significantly, and Hulu, which is also growing subscribers significantly. Total Hulu up 28%. Are you kidding me? ESPN Plus more than doubled. Without sports, they more than doubled. I mean, that's crazy stuff. So you need to consider that. And with Disney Plus, which is going to be the way forward and what values the stock, you're going to see a lot of new exclusives this next year because this is a company that realizes what Disney Plus means to them. And they're going to release a lot of exclusives to keep people coming on board. And I think that's really the future of this company, is this Disney Plus segment. As you see, just a new movie here, which I hate this lady, by the way. She's an awful actress, and I hate her. But she's in this new movie. Guess what? Original content. Here you go. That's what you've been asking for, and here you go. Original content, Disney. That's what's going to lead these guys to go. And that's why I think the stock deserves to be at a much higher multiple. By the end of next year, easily a $200 stock. Easily, in my opinion. So I think there's even more room for improvement beyond that. So keep that in mind. That's it for Disney. Next after them, Walmart. Walmart, why do I like Walmart? Well, Walmart stock, it's a very fair value play for a lot of reasons. Well, this is a stock that's just kind of done super well this year. It's a very boring stock typically, but up this year 25%. Really good year for it. And you think about everything going on and where Walmart benefits. I mean, everyone knows who Walmart is, the world's biggest retailer. World's biggest brick and mortar retailer, no doubt. And they sell every single segment, everything. So you got to consider that. As far as the stock itself valuation, why I like it is trading at a PE ratio of only 21.5, cheap. and a forward P of 25.9. It is high for historical values of this company. Typically, if you're looking a couple years back, they trade, right around a 20 or a little bit below. So valuation's not that steep at all. You see a price to sales ratio on this company boasting at 0.77. It's pretty darn cheap in terms of that. And if you look at the financials, you've seen incredible growth in terms of revenue this year. And that's going to be one of my main arguments for this company. Total revenue of $548 billion compared to $523 billion. So that's a growth of $20 billion in sales, where last year, year over year, they grew $10 billion only. So they doubled their growth rate in a matter of a year. That is the power of everything going on right now. That's the power of this virus, and people are spending money like no one's business. So the revenue is at incredible all-time highs, and they're right about now posting the biggest fourth quarter you probably will have ever seen of any company out. I mean, gosh dang, it's going to be a magnificent fourth quarter for any retailer. These are going to be blowout quarters, blowout numbers, as sales trends have continued to be strong. You've seen continued strong sales trends, and these holiday shopping time is going to be incredible. Christmas shopping is going to be off the chain, because to compensate for people's really, boredom and sometimes depression, even with everything going on, they're locked inside. People aren't happy. They're going to want a really good Christmas to end the year right. And they're going to buy a lot of stuff from Walmart. Let's just be honest. So sales trends have been ridiculous this year, and they're going to continue that way at least through the first quarter of next year. People are still going to be panicking. They're going to be hoarding. People are back to doing that. So I work in the industry, so trust me, I know. So keep an eye out on that, because sales are going to be incredible. And on top of that, they just launched Walmart Plus, which is one of my main things of why I love this stock right now. Walmart Plus, which they just announced now, free shipping with no minimum order. They had a minimum order of $35 to get free shipping, but now it's no minimum, competing directly with Amazon Prime. Directly. Free next day and 2-day shipping with no minimum order. You're talking about every type of delivery too, from groceries and house furniture to literally everything you can get delivered. Pretty crazy. On top of that, they boast the online grocery pickup, which is your curbside pickup, which isn't necessarily a Walmart Plus thing. It's just an in general Walmart thing. But we're talking about e-commerce here and how this company is incredible in terms of e-commerce and how they're taking market share back. Walmart grocery pickup, it's a contactless solution that people really love right now. They do the shopping for you. You just go and check in, saying you're there. They deliver your cart right out to you and get you hooked up and ready to go. So pretty crazy stuff. But with Walmart Plus, you also have fuel price savings, as well as Scan and Go, which is a really interesting app. It lets you do your own shopping on your own phone, so you don't have to go through any lines. You shop on your phone, pay on your phone, get checked at the exit door. You don't go through any lines, nothing at all. No registers, no self-checkouts, nothing. You just go do it on your phone. It's pretty nice, and I think a lot of people will pay for the luxury of that. As far as savings, they're saying it saves you 2.5 hours per week on an average of 3 trips per week, $84 a year in fuel, potentially $816 per year in terms of free delivery is what they're going to say there. So Walmart Plus, the numbers are going to be incredible. You look at Amazon Prime boasting right now 126 million members in the United States alone in terms of Amazon Prime. And Walmart has a bigger customer base. I don't think they're going to necessarily hit that number for a while, but I do believe when they release numbers, most likely at the end of the year, you're probably going to see a line somewhere close to 30 to 40 million subscribers to Walmart Plus. Now, many of these might be free trial users, so you need to consider that. But this is revenue that they're going to be making incredibly. $80 or $98 per year, or $12.95 a month. Most people are going to be doing the annual plan. You're talking about $100 a year at around 40 million subscribers by the end of the year. Think about that. That's $400 million they've just added to their revenue just from that alone. That's crazy. the numbers that they can do with this program over the next few years, it's going to be crazy, and it's going to add a lot of revenue to them. So that's why this stock's going to be going up. So keep that in mind with Walmart. As the trends continue, I think this is a really good value play. And on top of that, just mention this. You got to mention it. The dividend's incredible. They've been growing the dividend 47 years. Since they've been paying a dividend, it's grown. Payout ratio is only at 38%. They pay a quarterly dividend right now at 1.4%. 5-year growth rate's only at 2%, but they grow it by around 1 cent each year. So regardless, it's a 47-year growth. It shows you they've gone through multiple recessions. They will not be shrinking this dividend. They're not going to do it, okay? They're not going to be doing that. So it's a very good, safe stock to hold. I love this stock. Really good for you. My last stock for you is going to be Realty Income. Why do I like Realty Income? Well, it makes me cough. There's a lot of reasons. First, we look at what this company is. So, they boast themselves, first off, as a monthly dividend company, but this is a company that leases out to, obviously, certain companies, retailers, gyms, movie theaters. They lease out to these buildings to them, and obviously they get the money from the rent. They make rent money. And they've got one of the most diversified portfolios out there. 6,500 properties they have under long-term net lease agreements in 49 states, Puerto Rico, and the UK. 600 different tenants. Those are different owners from companies like Walgreens to LA Fitness, stuff like that. And 51 in retail and other industries. Pretty dang cool. As far as the dividend's concerned, obviously really good stuff. 15.3% compound annual return since 1994 is incredible. That's since this stock was listed. 604 consecutive monthly dividends paid, about to be 605 coming up. 4.5 annualized dividend growth rate. That's right, that's a lot. 92 consecutive quarterly increases on the dividend. Really freaking good. So you do think, obviously, there's a lot to consider. Financial-wise, the company's not really seeing a decrease in terms of revenue this year, even though they've seen some contractual rent issues. We've had loan forgiveness and rent forgiveness, obviously, this year, and it has hurt this company. There's no doubt. There's businesses that haven't been able to pay their rent because of the fact that they've been shut down because of the government, and that is a concern for the next few months for sure. So you need to take that into consideration. But what I like about it is that just this most recent quarter, they actually are back to doing pretty decent numbers. Typically, they're getting over 98% of their contractual rent. This last month, they brought in 93.6. So overall, pretty good. It is an improvement from 93.3. Not quite where they were, prior to this year, but that's not unexpected. On the bright side, though, I think it is a number that's growing, and you need to consider that. So I don't think you should have a concern in terms of people in their portfolio not, paying out for them. If we're talking long-term, this is a really, really good long-term hold that I think has capital gains associated with it, as well as your overall dividend, which is incredible. So this company's not going anywhere, and that's what I like about it. I do think they may, this upcoming year, diversify that portfolio a little bit differently because they have a lot of diversity in terms of companies, and some of that's going to be, again, as I mentioned, in gyms and movie theaters, with gyms completely shut down, movie theaters not necessarily going to be the longest standing things out there. So I do think they may do a little bit of reevaluation of portfolios. You may need to consider that, but always an incredible stock, Realty Income. The dividend is what I love it for. I think the valuation's not incredibly unfair by any means because the company's consistent, and regardless of where you buy it, this company will most likely give you gains in terms of dividend, obviously, but not only that, but I do think there's some capital gains you can get. That's what I got to say about and that's my stocks to buy for December. I really hope you enjoyed this.